of expert faculty speakers that we have here at the Leavey School of Business. We'll be discussing over the course of the quarter at least, and if not into next quarter, various topics as it relates to business and industry during this time of the COVID pandemic. My name is Nydia McGregor. I'm Faculty Director for MBA and Online Programs here at the Leavey School of Business. And it's really my pleasure today to introduce to you Meir Statman, Glenn Kilmick, Professor of Finance here at Santa Clara. Before Professor Statman gets started, I want to remind you of a couple housekeeping things. So be sure to have yourself muted right now so that you can keep quiet while Professor Statman is talking. But if you have questions, feel free to post your questions in the chat. I'll keep track of those questions, and after about 20 or 25 minutes of presentation, we will get a chance to break into more of a Q&A sort of format, and I'll be able to pass your questions along to Professor Statman at that time. Looks like we've got a turnout of both undergrads and graduate students. We have prospects. So whoever you are and wherever you are, welcome. And we're going to get this started. So Professor Statman is in the finance department. His area of expertise is in behavioral finance. He is renowned throughout the world for both his research and his books on the topic. And he speaks both to the, I'll call it the academic side of the world, as well as to the practitioner side of the world with his insights in behavioral finance, and in particular in what's called the second generation of behavioral finance, which is the most recent update of that research. His talk today is Behavioral Finance in the Time of COVID-19. And I think without further ado, go ahead and take it from there.
Thank you, Nydia, and good afternoon to all of you. I'm delighted to be with you. Now, what do these photos tell us about who we are? They tell us that we are compassionate people. On the left, you see a pantry that was built by one of our neighbors, stocked with food for everyone who needs it, can come and take it. On the right, you see the little free library where in usual times people bring a book or take a book, but now it also offers face masks to everyone who needs it. What do those photos show us? Again, it shows us that we are compassionate people. On the left, you see a long line of needy people waiting for food. On the right, you see a volunteer who is handing out that food. Now, a general point that I make is that we are normal. You, me, all of us are normal. We are neither computer-like rational nor bumbling idiot irrational. How do I check that you are normal? Very easy. Here's the checklist. Do you want to avoid poverty? Check. Do you want prospect for riches? Do you want to nurture your children? Do you want high social status? You might deny it, but I don't believe it. You do. And you want to be true to your values, including compassion. Now, on the way to what we want, we use cognitive and emotional shortcuts, and sometimes we commit cognitive and emotional errors, and I will speak about them briefly in just a bit. But first, what is it that we want? In each product and service, we want three kinds of benefits: utilitarian, expressive, and emotional, and that applies everywhere, including to financial products and services. Now, in this particular case, here's a woman, volunteer, on the right. Utilitarian benefits are, what does it do for my pocketbook? Well, in this particular case, it does nothing for her pocketbook. In fact, it is costly to her. She is spending her time as a volunteer, but she gets a lot out of it in expressive benefits and emotional benefits. Expressive benefits are, what does it say about me? Not just to other people, but to me as well. I am a compassionate person. And how does it make me feel? It makes me feel proud and enjoy peace of mind because I stay true to my values. Now you see that everywhere. You see that in saving and investing. You see that father with a sleeping toddler on his shoulder. Utilitarian benefit of savings. I have money to support my children, but it also says I'm a responsible parent and I'm proud and enjoy peace of mind because I support my children. Think about lotteries, lottery tickets. Why do people, normal people, buy lottery tickets? Well, it has utilitarian benefits. I will be rich if I win, but also expressive and emotional ones. I am a player with a chance to be rich, and I savor the hope of being rich. So now I use that example of the lottery ticket to illustrate the difference between standard finance, the first generation of behavioral finance, and the second generation of behavioral finance. In standard finance, people are rational, and rational people want only wealth, and they're immune to cognitive and emotional errors that diminish wealth. And so rational people don't buy lottery tickets because, as we all know, lottery tickets have negative returns with high standard deviations. In the first generation of behavioral finance, we describe people as irrational. Now, irrational people still want the same benefits as rational ones. They want wealth, but cognitive and emotional errors cause them to take actions that diminish wealth. For example, irrational people think that the odds of winning the lottery are 1 in 100 million, when in truth, they are 1 out of 200 billion. Normal people in the second generation of behavioral finance are, again, people like you and me, and our wants extend beyond wealth. So imagine that you are about to buy a lottery ticket and I say, listen, you have the odds calculated wrong. The odds are actually 1 out of 200 million, not 1 out of 100 million. Will it deter you from buying that lottery ticket? I'm pretty sure that it won't. Now, normal people do commit cognitive and emotional errors, but they do so on the way to satisfying wants. So let me talk briefly about some cognitive errors and how they manifest themselves in these days. So you hear an investor say, I sell stocks now because bad news about COVID-19 will continue to depress stock prices. The question that you should be asking is, if you are selling, who is the idiot who is buying my stocks? And if you buy more stocks now because good news about COVID-19 will now lift stock prices, you have to ask the same question, who is the idiot selling these stocks? So we tend to frame trading as tennis that is played against the practice wall. That's very easy. You buy and you sell, but the correct framing of trading is like tennis plays against Roger Federer. So who is the idiot on the other side of the trading net? You have to frame it as real tennis, and you are playing against high-frequency traders or people with inside information. And if you ask yourself, how is it that high-frequency traders make a lot of money? It is because there are many normal investors who are not very wise, who trade with them. So I frame it now, place it in the context of market efficiency. There are two notions of market efficiency. One is a market where prices of securities always equal their intrinsic values. And the other admits that prices deviate from these intrinsic values, but it's really hard to tell when, in which direction. Now, prices do deviate from value, but it's hard to beat the market. The way I usually say it, yes, the market is crazy, but this does not make you a psychiatrist. Now, some people do beat a hard to beat market. So think about the Dr. Fauci's people of this world. Well, they had better information in January than the rest of us. And if they traded on inside information, and I assume they did not, they would have beaten the market. Some Congress people actually got the exclusive briefings from them, and some of them went ahead and did trade on inside information, but most of us have nothing but widely available information, what we hear on television, what we read in newspapers. And so the question really is, why is it that people who have no access to narrowly available information choose to trade? And one reason takes us back to framing, because they don't really understand how markets work. And second, even if they understand it, they are overconfident. You know, I never played against Federer, so I guess my chances are 50-50 to beat him. Representativeness is another cognitive error. So you might say, I buy stocks because COVID-19 time is representative of, similar to March 2009, just before the stock market boom. And I say, are you sure? Is it possible that this COVID-19 time is representative of October 29, when the stock market bottomed only in 1932? And is it possible that it is similar to neither of them, and you just don't know which way it is going to go? I talked about cognitive errors. I will talk about emotions briefly. Hope and fear are useful emotional shortcuts. Fear causes us to press hard on the brake when the car in front of us stops suddenly, but excessive hope, irrational exuberance is an error, and so is panic. Now, we are intelligent people, and we can use cognition to pause and step away from our emotions. When angry, count till 10, said your mother, before you open your mouth, because you know that angry words cannot be taken back. And there can be excessive fear, panic, that is an emotional error, and you can step away from this fear before it turns into panic. How can you tell whether it is legitimate fear or panic? Again, ask the Dr. Fauci's of the world, consult the experts, and they will give you the truth about where we stand. And you can use cognition to see the silver lining in your investment losses by realizing these losses and at least getting some tax benefits. So if you get into panic and you buy a ton of toilet paper, it's no big deal. You can take it back to Target and they will refund your money. But if you sell all your stocks in a panic, as unfortunately many people did in 2009 and perhaps today, that is, of course, a much bigger problem. So I'm coming back to who we are and what it is that we want. And at Santa Clara University, we, teachers and staff, help you, our students, grow into people for others. We help you grow into people of competence, conscience, and compassion. And our compassion extends beyond our school. I do some of my work helping others at school and some beyond it. Nava, my wife, does her work as a volunteer for NAMI, the National Alliance on Mental Illness, and I'm sure that you're doing your part. And if COVID-19 does us any good, it will remind us who we really are and what it is that we really want. Thank you all very much, and I turn it back to Nydia.
Thank you so much. That really helps us understand a little bit more about how we should be thinking perhaps about our behavior right now. We have gotten a couple of questions. I'll let people know if they want to put more questions into the chat, feel free to do so now. But let me start with the first question that's been posed. The question is about fear and panic and the idea that those can be very contagious, right? That if I'm experiencing this and I begin behaving one way, that other people observe my behavior at that time and that they can then decide that that's a good way to behave. And the question is, what is the counter effect? In other words, what can we do to offset that panic and fear? And I think that's both a question of terms of an individual, but also a question of in terms of when you see other people behaving in a way, how to stop that contagion.
Well, sometimes this question is asked in the context of herding. And the notion really is that you should not listen or should not watch or you should not follow other people. But that is too extreme. That is, if you are in Chinatown and you see two restaurants and one is full and the other one is pretty empty, I say join the herd, go to the busy restaurant. It is possible that those people are as ignorant as you are, but in all likelihood, some of them know what they're doing and they know that the food in that restaurant is better. But at other time, of course, that herd can mislead you. And how can you tell the difference? Well, for that, you need to have expertise. And not all of us can have the expertise of physicians or virologists, but we can listen to experts such as Dr. Fauci again, and find a way to separate facts from myth. Listen to Fauci's, don't listen to politicians, and they will guide you right.
So then it seems to me that a lot of what you're talking about is, if not asymmetric information or lack of information, and as normal people, to use that language, we just don't have the amount of information that we might assume that we have. Is that a better way to describe what constitutes a normal person?
Well, normal people, again, normal people, I say, are usually normal, smart, and normal, knowledgeable, but sometimes we are normal, stupid, and normal, ignorant. But we are intelligent, which means that we can learn and we can improve that ratio of smart to stupid. And this applies here as well. Again, if you have that expertise, I have expertise in investments, but I know very little about medicine, but I know that I can trust physicians, especially physicians, say, in the National Institutes of Health in this particular context. And so it is the problem that we face now between news and fake news. And the rule that says listen to experts is a good one. Listen to politicians is a bad rule. And so you can kind of have general principles or general modes of action. For example, when in sort of you feel panic, calm yourself down, don't trade. The real answer to the market in times of turbulence is do nothing. And if you do nothing, as I do, you're going to also be blameless. So there's not even going to be this pain of regret if you got out of the market and the market zooms, or you got in and the market collapses.
So to build on that and related to a question that we've got here, what do you think the early observations are telling us about how we're responding right now? What do the markets reveal about, are people following this general guideline at the moment where, you know, there's a lot of turbulence, don't do anything? Or are we seeing a lot of, I'll call it normal people errors with an increased amount of trading as people are trying to flee from what they perceive to be a very dangerous situation?
Well, the good news is that when it comes to 401k and 403b, people generally do nothing, which is a good thing. But then you have a segment of people who really think that they are very smart and they are trading. They are picking this stock or that stock. I don't know if you've seen this piece of news, but it turns out that the ticker symbol of Zoom, I think, is ZM, but Zoom, ZOOM, is a ticker symbol of some defunct Chinese company. And many people who thought that they are going to be very smart by buying Zoom bought that defunct Chinese company. And so remember, you are not playing against the wall. You are playing against people on the other side who are professionals. And you always have to ask yourself, who is the idiot in this trade? And if you are a typical individual investor, you are likely to be that idiot. And so if you can just accept that and not trade, you are going to save yourself a lot of money and accumulate much more for retirement.
Building on those questions, here's another one. This is from Matthew Watson. He asks, it seems that markets are driven by the herd and not necessarily by the Faucis, at least in the short term. So are those corrected over the long term? Do the Faucis always win out, I guess is the way to sum that up?
Well, there's not a matter of just kind of turbulation and then it stabilizes. There's always information. In fact, Hersh Shefrin and I, years ago, we used an analogy to describe how prices are determined. We talked about a car that is driven by two drivers who are fighting over the steering wheel. One is that rational one who just follows the fundamentals. That is, what can we say about the price of oil? What can we say about when the economy will come back to normal and so on. But then you have this other driver who is the sentiment driver. And that sentiment driver pulls it up when exuberant and down when it is in panic. And so prices are never ones that you can trust are going to be equal to intrinsic value. But the point is that you cannot even tell which sentiment you are in now and when it is going to stop. So it might be that people are now overly pessimistic. Well, so you say, I'm going to buy. Well, suppose that people become even more pessimistic and the price goes lower. And so the thing is that when you see lots of people fighting, maybe what you should do is just step away from it rather than join that fight.
So if I could reframe that, it seems like during this turbulence for a normal person, it's actually very difficult to find the information that you would need in order to be an informed investor at this point in time. Does that seem like a good sum up?
That is right. You know, years ago, think about it as an accident, as a traffic accident. Years ago, I was driving on 280 suddenly the cars in front of me stopped. I slammed the brake. I stopped 3 feet in front of the car in front of me. I could see a Lincoln Continental in the rearview mirror racing towards me, and the driver on his cell phone. So I knew that I'm going to get hit, and I was. Now, this was not a fender bender. This was a case where the car was total. But the first thing that you do in such an emergency is not figure out how you negotiate with the insurance company about the compensation for the car. What you do is you check, is anybody bleeding? Is somebody in need of help? Then you say, if not, then get those cars off the road so that you're not going to be hit again. Then call the AAA and so on. So the same applies here. We are just hit by this Lincoln Continental. What we should do now is figure out if anyone is bleeding. And the answer is no. And so don't play with your portfolio. That is not what you need to do at this moment. What you need to do really is figure out those things that really matter. Will you have a job? Are you going to be ill? What are you going to do to help your family? What are you going to do to help other people who are needy when you have the resources to help? These are the things that matter. Issues other than realizing losses, there's really nothing that is wise to do in your portfolio.
So we've had a couple of questions, I think, that are addressing this idea that we should just not do much, and wondering what role advisors, financial advisors, might play for folks in this situation, but also in general for what I'll call a normal investor.
Well, financial advisors are experts, and they're experts on both the facts of finance and about human behavior. So advisors know behavioral finance, and they knew it before those of us who are scholars in the area have come to know it. And so what advisors do is that they try to be educators, just like we professors. That is, they explain to clients who say, this is a wonderful opportunity. It is like March 2009, and if I just double my allocation to stocks, I'm going to be a winner. And they say, not so fast. How about if we slow down? How about if we sleep on it for 2 weeks before we take action? How about if you're going to buy it by dollar cost averaging, spreading your buys over a year rather than jump all in? Or jump all out if you are too afraid and you want to sell it all. And so advisors are immensely, immensely valuable. And they are valuable in large extent in protecting people from themselves, in addition to providing them just sound advice about things like a proper asset allocation and how to arrange your financial plan for retirement, and so on.
Thanks for that. I think that was really helpful. The other questions that we've got from folks have to do with what sorts of, I don't know if they're rules of thumb or other kinds of recommendations you would make for normal people who understand that they might make errors as a result of heuristics or biases or just computational errors because we are human. And if you have some keys or rules of thumb for being able to be investors and avoid some of those errors.
Well, one piece of advice which I think is good and that I follow myself is not to buy individual stocks or individual bonds. I say individual investors have no business buying individual stocks. The reason for that is, again, that when you are a naive and amateur investor and you buy the stock of Zoom or Apple or whatever it is, you are buying it based on widely available information. And if you're lucky, you have another person who is ignorant as you are on the other side of the trade. And if you're not, you have an insider or a high frequency trader. And so in general, on average, you're going to be a loser. Now, the nice thing about a mutual funds, especially a very widely diversified mutual fund, like a total stock market fund, whether you buy it from this mutual fund company or another, is that it has more than 3,000 stocks. And so one, you don't place yourself in a situation where you are facing an insider. And second, you get the benefits of diversification. Now, people often have very mistaken notions of diversification. They say, gee, you know, this fund has more than 3,000 stocks. I don't even know the names of 100, let alone having looked at their income statement and balance sheets. But I know this company, I know my companies, and so I'm going to put a lot of money in my company. Well, that feels secure. Secure as telling yourself that you don't need a safety belt in your car, that if you see a car rushing towards you, you just hold tight to the steering wheel. This is not going to work. And so I say buy widely diversified mutual funds, index funds. You can get them with expense ratios of 4 basis points, 0.04 of 1% per year. Buy one for US stocks, buy one for international stocks, buy one for bonds. Make your life really, really simple. There are better things for you to do over the weekend than pour over accounting information about companies. Play with your children. Speak with your wife or husband. Make it really simple. That is what I do. And you know what? Also learn to shrug. So the market goes up. Well, that's in the act of God that favors me. The market goes down. You know, the God of the market has nothing particular against me. I just shrug and I focus on what matters. What matters is my family, my career, my knowledge, my studies. The stock market, for some reason, looks like it's an easy thing to get into, but that is, or rather to win and play that game. But this is a trap. And you have many professionals who take advantage of the fact that we do commit those cognitive and emotional errors. And instead of trying to educate us to avoid them, they take advantage of them. This is why you come to Santa Clara University to get education rather than false news.
One last question about normal investors. Are there markets where normal investors are more likely to commit emotional errors rather than other markets? So is there variance among markets that sort of triggers more emotional response and therefore the committing of more errors?
Well, I imagine that generally a volatile market, a market that has gone up or gone down, causes people to think, where is it going next? And actually some people, many people, most people in fact, extrapolate. Most people think that if the market has gone up, it will continue to go up. But then you have contrarians, and they're not necessarily smarter, who say if the market has gone up, it will now reverse itself and go down. Neither of them is right. The market just goes in that random walk. and trying to figure it out is not a job for amateurs. It is not even a job for professionals. I say, you watch CNBC, you see two experts. How do you know they're experts? They're wearing suits. One says the market will go up, one says the market goes down. Well, one of them is wrong. I don't know which one. How about getting somebody else, maybe wearing a t-shirt, who just says, I don't know? That is the right answer. Again, this market game is a market that seems easy. That is, starting a restaurant is difficult. Starting a car company is really difficult. Buying a stock, that's very easy. And so people think that that is something where they have an advantage because they are very smart. But they are not. It is really, it's not like the Nigerian schemes, but it has some of the elements of it. That is, it relies on people's desire to be rich, to win, and they reel you in and they empty your pockets.
I hate to say that doesn't sound very optimistic.
Oh, I think of it as being very optimistic. That is, if you want to be rich, start a company, acquire education, move up to a better position. And there are many ways to be rich. Get an education. But the notion that you can be rich by investing in stocks is foolish. I mean, you think about Warren Buffett. You say, see, Warren Buffett made his money in stocks. No, Warren Buffett didn't make his money in stocks. Warren Buffett bought a small company and made it into a giant one. And you did not know it before. And you don't know what the next Berkshire Hathaway is going to be. And so you have to just see where you can actually advance and where you cannot. And if you get to retirement and you have just middling income, then it is too late for you to do the next Google or Apple. Well, you can either be happy with what you have, and a lot of people actually have that, and it is a wonderful thing. That is, people who have just a modest amount of money, but still live below their means and know what is important in life. And that is the way that you can do. And if you still want to be very rich, once a week, spend $1 on a lottery ticket. Somebody is going to win. Why not you?
I have a question here that's a little more specific. So I'm just going to read the question as it stands. Will you give some comments or thoughts on having foundational non-correlated assets in the portfolio to release performance pressure from the market activities or portfolios?
Yes, so people look for non-correlated assets to put in their portfolios. And that is generally a good idea. Now, generally, the notion is that stocks and bonds move in opposite direction. And so you're doing well by having both of them. More recently, they've actually moved in the same direction. And so don't pay as much attention to correlations. Ask yourself this: what are the return gaps between securities? That is, in some years, stocks do much, much better than bonds. In other years, bonds actually do better. When you have both of them, then you're going to be in the middle. That is, diversification means mediocrity. If you diversify, you will never have your entire portfolio in the winning asset. You will never be a hero, but then you will never have all your portfolio in the worst asset. You will never be the GOAT. You will be in the middle. That is the benefit of diversification. And you can set the issue of correlation aside. I wrote a paper about that, and I'm not going to try to summarize it here. And so again, if you have a diversified portfolio, actually think about it as a behavioral finance guy. Think about it not in terms of diversification, but in terms of your wants. I say we want two things in life. One is not to be poor, and the other is to be rich. Well, it's a bit exaggerated, but that is not a bad approximation. So think of, if you are young, your not being poor is mostly what we call human capital. It is the money that you're going to earn during your career. Then that is your bond. And it is perfectly fine then in your 401k to put everything else in stocks. But as you age, that changes. Your human capital diminishes and your portfolio hopefully fattens. And it is time to be more conservative, or depending on the circumstances, if you find yourself having more money than you imagine and you have enough for downside protection, say in bonds, then let your profits go up, keep it in stocks. You know, the stock market went down. I don't have to disclose my entire portfolio for you to guess that my portfolio is worth now less than it was worth in January. But as I said, I just shrugged because I know that I will not be poor because I prepared things for myself such that I have a foundation of, say, bonds in my portfolio that they plus Social Security and other sources of income are going to do well to sustain me in retirement.
Building on that, could you comment about cash value life insurance and other low risk or tax-free buckets? We've just had a question that builds on that.
Yeah, well, so there are various views on that, and some of it gets to be kind of religion. People are very passionate about it. My own sense is that savings are savings and insurance is insurance. So I do not buy cash value insurance. I bought, at the time, just a life insurance that in fact expired 20 years after. And so I bought it in, I think, 89. And by 2009, it was gone. And when I asked how much it would cost to buy more of it, the price was enormous. And I just realized that I don't really need that because by then I've accumulated enough assets and my kids are grown up and so on. So insurance is for insurance. That is, if you are a parent and you are concerned about what will happen to your family if you are gone, that is a good time to buy insurance, buy term insurance. Once you get to complicated products, financial products, forgive me for saying that because there might be financial advisors here who might have different views. But if there is something that is complicated, it is likely something that bears a lot of costs that are income for brokers and financial advisors. And I say the simpler, the better. Buy insurance, term insurance, and keep your savings in your portfolio.
Thank you for that. We have some questions that run a little farther afield. One question is about businesses right now during these relatively turbulent times. Ford, as well as plenty of other firms, if they can, tend to borrow during expansions and make investments, especially during economic crises. So what are your thoughts for some companies that are doing well now? Would you recommend that during COVID-19 they make investments if they can, or engage in borrowing to get better terms?
Sure. I mean, the time to fix your roof is when the sun shines. And so if you are in a situation where you can buy oil for a negative price, and you can hire workers because many of them are out and they're just going to be delighted to have a job. And if you can invest in machinery, in products, getting yourself ready for when the world is going to be better, this really is the time to do it, not when everyone is rushing. And so, you know, the time to get a contractor to do something in your backyard is now. It is not when everybody is flush with money and times are good and everybody is looking for contractors.
Thank you for that. I have another question that is more of a policy question, but I'm wondering what your thoughts would be as it relates to how we understand the way people behave. Currently, policymakers at all levels of government, whether that's local or state or federal, seem to be trying to balance three things: liberty, like freedom of movement; privacy, meaning just people's health status, right? Do I have COVID? Do I not have COVID? As well as security, just generally, is the public safe? And I'm wondering, given these trade-offs, it doesn't seem like we will be able to accomplish all of them completely. That there seems to be, maybe you get to pick two. You can't get all three. So I'm wondering if there are any lessons from behavioral finance that can inform how we should think or frame this kind of policy tension as it relates to this particular moment in time.
Well, when we talk about those utilitarian, expressive, and emotional benefits, we always have in mind trade-offs. So when you contribute money to Second Harvest, you feel good that you are helping people who need food and you have more than you actually need. But of course, you give up some of your wealth. And so you lose utilitarian benefits. And so you make that trade-off. So I contribute to Second Harvest, but I do not contribute everything I have to Second Harvest. I balance what I need for myself and my family and what I can spare for people who are needier than me. The same applies to issues of public policy. For some people, issues of privacy matter greatly. Actually, for me, they don't. I mean, I'm kind of puzzled. I don't know if it's an American thing about privacy, but I always think that people who want privacy are people who want to project an image that is different from who they really are. And if you were to open their closet and see what they have, you'll find that they are just like the rest of us. That is, they are, you know, they are very generally virtuous, but they're also vain and so on. But more generally, right now, we are going to be facing a problem or a debate that we have been facing before, which is, do we have a safety net that is too strong? As some people say, that the poor are just lazy and they don't go to work like the rest of us? Or is it the case that our safety net is too weak? And if you look at the people who are standing in line to collect food and people who have lost their jobs, people who live paycheck to paycheck, I think that we have a safety net that is too weak rather than too strong. And so we are going to have this debate in the social arena and in the political arena, and it is a good debate to have. We're going to have similar debates. We're going to have debates about medicine. How are we going to arrange the medical field now that we have experienced what medicine is doing and cannot do, and what it is that physicians do, what it is that nurses do, what it is that people who work in nursing home do, and so on. You know, right now we have issues of scope of work. That is, physicians are a cartel, and they say, if a nurse works, she has to work under the supervision of the physician. Physicians say this because we want to protect patients. Economists say, we have heard that before. It is because you want to protect your incomes. And nurses on the other side say that workers in nursing homes should not be allowed to administer injections because that is their job. So I hope that we are going to have that kind of debate, and perhaps takes this opportunity to break those cartels. And so now that we have kind of gotten to shake up things, not because we wanted to, but because that COVID-19 is upon us, I hope that we are going to ask ourselves these difficult questions, and I hope that we are going to listen to one another and debate it, and perhaps end up in a better place than we are now, and even the place we were just before this pandemic.
Well, I'm going to ask one more question, and it goes back a little bit to the diversification question that we were talking about earlier. We have the question of, you know, it's clear that diversification seems to be useful, but would you say that given this current situation that's very unique and completely unexpected, that the efficient market hypothesis doesn't apply here? And so when industries stand out or are in decline at this time, that that would contradict the suggestion to have diversification at the moment, because you could find some unique individual investment opportunities.
Well, I always go to the point of, what do you know that other people do not know? So if you have an industry that is going up, the price has already gone up. You don't have a sale like tuna cans in a supermarket where it is 50 cents on sale, and if they run out of it, then they'll give you a rain check. Here, if you hear on television that this stock is a good stock and you rush to buy it, you find that other people have been already ahead of you. And so the question is not whether the market is efficient. Again, there are two notions of market efficiency. The market is crazy. The market is inefficient in the sense that prices deviate from value. But this does not make you a psychiatrist. This does not make you somebody who can tell in which crazy direction the market works. And so you have to restrain yourself and realize that unless you have some true advantage, not that you understand, that you're very smart and you read the papers and so on, but if you have a true advantage without stepping into what is illegal insider trading, then you would want to trade. If it comes to me, I say I have no information that is not known to professionals in the market. And so why would I play against a professional? Why would I play tennis against a professional knowing that the loser pays $100,000 to the winner? It might be fun to play against Federer, but I'm not going to do that if it is a sure $10,000 going from my pocket to his.
Thank you so much for putting a finer point on that. I think we've covered just about everybody's questions. If I can say thank you to you for helping us to understand better how to control our fear in these contagion times, and also for understanding how we might be able to increase the ratio of smart to dumb I'll always remember to fix my roof when the sun is shining. I think that's one of my key takeaways.
That is inside information.
Thank you, everybody who joined us today. And we will definitely post a recording so that people can have access to it and the slides. We will continue our conversation next week on April 29th with these two faculty members who are going to join us then, Professor Desmond Lowe and Professor Alex Field. They will be talking about challenges to firms under macroeconomic and pandemic uncertainty. We will have more after that as well. So have a great evening. Professor Statman, thank you so very much for treating us to this conversation today. I hope everybody stays safe and well, and hopefully we'll see you next time. Take care. And you got lots of thank yous, Meir.
Oh, thank you. It was delightful to have a chance to speak with our students and with you.
Yes, it was lovely. Thank you for taking the time. We will, Min will take care of the recording for us. I did have a couple of students who asked about your slides. Is it okay if we circulate those?
Sure.
I figured they're going to be on the recording, but just wanted to be sure that that was all right.
Sure, it's all right.
All right. Well, thank you very much.
Thank you.
Thank you, Meir. Thank you, Nydia, for everything. That was great.
Good night.
Thanks, Min. I noticed we had
all.
about 54 people on. That was a good turnout, I think.
Thanks,
Yeah.
Min. That was very kind of you and very efficient. If you made it work for me, that's a big deal. But I made it.
You did.
You
Absolutely.
made it. You made it.
It's terrific.
Thanks again.
Right.
Good night.
Perfect. Thanks, everyone. Have a great evening.
Thanks.
Bye.
Bye-bye.
Bye.